welcome everybody. Greetings, agents of impact, as we say in the brief every morning. It's great to see so many of you on the call. As always, so many of you could be speakers on the call. We hope you do participate. But in the meantime, as Zulema said, go ahead and carry on our Agents of Impact call tradition and introduce yourself in the chat and maybe say where you're coming from geographically, but also say, just for in honor of this call, what incentivizes your impact, and put a little comment in there if you like. And as an added incentive, we've been rounding up the introductions in the call write-up that we'll do at the end of the week. So if you want to see your name in bold print, go ahead and introduce yourself. Let me bring in my colleague, Jessica Pothering. Hi, Jessica.
Hi, David.
Coming to us now from Lisbon. No, not yet.
Charleston, South Carolina.
Charleston, South Carolina, but you've moved to Lisbon. We have quite a geographic diversity here. But before we get to the guests, let's just set the stage a little bit. You've been covering this now and setting it up with a bunch of calls. What have you learned about the world of impact incentives?
It's interesting. I think when we first, I don't know, maybe our first story on this, or at least the first one I wrote, was 5-6 years ago. And I just remember, as covering deal news, always being really excited when I saw something like some sort of impact-linked financing deal or impact-linked carry, because it seemed so unusual at the time. And this body of work that Aunnie has led and just published with the impact-linked compensation project really shows how much traction this is starting to get in the impact investing field. And so I think that it's neat to see how a bunch of sort of anecdotal examples that we've been compiling over the years fit into a much bigger body of work, and represents how this is gathering steam in the broader impact investing field.
Great. The how, I think, is key, and we've been saying in the setup that this call really wants to focus on the how. As you said, 5 or 6 years ago, it was sort of the weather to do impact incentives, and now I think people are getting down to, well, how does this really work? How do you implement these things, and what are the different options for incentivizing? And we always found it kind of ironic that incentivizing impact was such a controversial thing among impact investors, but here we are. So let's introduce our guests. Aunnie, Patton Power, you've been our guide through all of this. Welcome.
Thank you. Great to be here, as always.
And you're coming to us from South Africa, I believe.
From South Africa.
I want to get the geographic diversity here. Uli G, you counseled me to introduce you as. So from the European Investment Fund, welcome.
Hi, everyone. Very pleased
Uli,
to be with you.
you're gonna be our asset allocator and also fund-to-funds manager, just so people can understand the sort of levels of the finance stack here. Now we have two fund managers. Santiago Alvarez from Alive Ventures. Welcome, Santiago.
Hi, David. Thank you for the invitation. And out of Bogota, Colombia.
Bogota, great. And Gilberto Ribeiro from Vox Capital, from Sao Paulo, I believe, right, Gilberto?
Yes, São Paulo, Brazil. Thank you, David, for the invitation. Thank you, Impact Alpha, for putting this together, because this is such an important topic for the advancement of our industry, and I'm excited to be here.
Fantastic. Thank you for joining. And Bjoern Struewer, I'm sure I bangled that. Bjoern, welcome.
Yeah, hi, nice to meet you all. I'm joining from Frankfurt, Germany.
So we have quite a spread here, but the wonders of Zoom, we take it for granted now. A few years ago, it wouldn't have been possible. Also, I was going to make a comment about the cold weather in many parts of the country, but I think that for some of our participants, it's summertime, so you can either you can visit them and get a little break from the cold. So. Aunnie, let's jump right in. Just give us the state of play here. Jessica sort of charted the course from a few years ago to now, but you've been digging in on where we stand. So kind of set us up.
Sure, David. So I think, as Jessica said, those of us that are in the space for a while, right? This is a topic that we've talked about, but as you said, it's been controversial. And I think what's interesting is that I saw a peek into maybe that it had changed last year. So not 2023, but 2022 at GIN. I was doing a panel and I had 4 large asset allocators, quite a lot of money on the stage. And when we were prepping, I said to them, oh, I'm going to ask you something super controversial. I'm going to say, you know, or I'm actually going to say something super controversial. I'm going to say that I think that, you know, impact link incentives should be table stakes. Like this should be, you shouldn't be able to call yourself a manager without that. And instead of them going, oh, all of them went, yeah. And I kind of went, wait, what? Like I was expecting this to be a controversial thing. And so for me, that kind of was, I was like, oh, I think potentially there's been a bit of a change and maybe we're just actually not talking about it. And so what happened after that panel, I said it and people agreed and, you know, we did an article in Impact Alpha. And then, you know, what really happened after that is people just started writing to me, not disagreeing necessarily. There was some great debate, but saying, okay, how do we do it? And I was like, oh, okay, I don't know. So this was where, you know, we went and got some funding from the Tipping Point Fund. And, you know, when we originally designed the survey, we kind of said, all right, well, we think there's probably like 30 or 40 funds that are doing this. It'll be pretty easy to get to them. We did desktop research, identified, you know, a chunk of them and had told the funders, like, we'll go out, we'll do this. We'll do, you know, 15 or so interviews and then we'll be good. But we ended up putting the survey out and, you know, we didn't know if anyone would respond. And we suddenly had literally hundreds of responses and over 100 funds that were doing this. And so it was, the first finding was kind of a little bit, oh dear, like this is going to be a bigger project than we thought. But it was also what we realized is that a lot of people had started to implement this without shouting it from the rooftops because everyone felt like they were learning. And that was one of the biggest kind of takeaways that we took from this research was that there's a lot of fund managers that are not afraid to try things, even though, you know, they don't necessarily know what the best practices are. And I think that's emblematic of our field. If we had waited to understand what the best practices of impact investing was to start impact investing, we wouldn't have 10-year-old funds.
There you go.
Aunnie, can you talk a little bit about sort of the range of incentives that you saw come up throughout the research? I think often what the the sort of controversial issue comes up around impact linked carry, which you can maybe talk about for a second. But from your research, you dredged up a lot of other different type of incentive models that people are using, right? So it's not just one thing.
Yeah, absolutely. And, you know, I would just say that Blue Mark has done a lot of this work around looking at kind of the different levels and being able to collect some of this information, which was great for us. And we worked closely with them on it. But really, you know, we and they look at kind of 3 different levels. So you have carry, which is the profit share between a GP and an LP, and that can be linked to impact. And that's something that people often think is the only, as you said, Jessica, the only way to do it. There's also bonuses, which work really well for organizations, particularly the non-traditional LPGP funds that are, for instance, nonprofit funds, real estate funds, things that don't necessarily have that kind of profit at the end, that can do more like annual, semi-annual, or even long-term bonuses, look more like corporates. You also have performance evaluations. So this is where employees are incentivized through promotions, through different types of grading and scoring, however it works, to be able to be actually linked to impact. And that's just at the between kind of the GP necessarily, or the fund manager, and the LP, or within the LP. Now, there's also a whole range of things that I'm sure Bjoern will talk about between the GP and the entrepreneur that can be around financing. And that was beyond the scope of this report, but pairs up very nicely with this idea of incentivizing incentivizing companies. But what we really looked at was internally within fund managers, and the area that we didn't go into as much as we'd like that needs to be done is looking at within LPs. So family offices, foundations, et cetera. And I think that's the next piece of this work that is quite interesting as well.
I always think of my mother who attends some of these calls, and maybe in fact on this call, and always says, "I don't know what you're talking about." So so I just want to make sure that everybody understands when we say carry, which you'll probably hear a lot in this conversation, that means carried interest, as you said, the share of profits that the fund managers get out of the fund. When people think of a 2 and 20 fund, a typical fund, that's the 20, right? 20. And what we're talking about now is, in addition to that financial, or as a part of that financial profit, there's a impact component that goes into that, not just the returns on those investments. So I have that right, Aunnie?
Exactly. Yep. And then in addition, bonuses and everything else. Yeah.
And then bonuses and all the rest. And are there examples where anybody has ever not received the carries, just say, because they didn't hit their impact targets? Like, is this a real thing, or is this just sort of aspirational?
So it's a good question. There's a couple answers. So one is that one of the things that we found is that there's obviously a few ways to do this. There's the kind of traditional on-off switch, which is you hit the target, you get the carry. You didn't hit the target, you don't get the carry. We actually see, I think that's the traditional way of thinking about carry. How it normally works is there's a hurdle, a return, a financial return that you have to achieve before you get it. And so people, a lot of particularly funds that have done this as just kind of taking the financial model and adapting it, have used that. But what we're seeing increasingly in the research is actually more gradual. So there'll be a linking between, so you hit an extra 1% saved from a landfill, you get an extra 1% on the carry. And so we've seen some of those. Now, the actual question about the money being paid, I'm glad Vox is here because they've actually been through Alive as well, have been through the whole cycle. Actually, what we found is that the majority, about 49% of our respondents have put in impact-linked incentives in the last 3 years. So this means that unless they're bonuses, they likely have not gone through the full cycle. So what we've said in our research is that this is first-generation data. We do have some great funds, like on the call, that have been able to been through the whole cycle, but it's still a relatively small percentage, around kind of 20% of the funds that we looked at that had actually paid out carry. And so it's still a small number that to be able to know, are those other 80% actually going to pay out? And just one more thing to add here. One of the things that we found that's really important from this is that flexibility is built in. So very few of these fund managers and these LPs are setting out to make this punitive. They're not trying to set something to say, all right, when you miss this by 3 people, you're going to lose out on all of this carry. A lot of times what we've seen is this flexibility around governance to be able to adapt metrics when a global pandemic happens, when there's, a complete, there's a difference in what you're expecting, to be able to potentially adjust those with governance, like with strong governance and oversight. So we don't necessarily anticipate there being this massive cutoff, but we'll see. So that data will be interesting to see in the coming years.
One more question, just on the sort of setting the stage level. Kinds of impact that gets measured. You mentioned, waste diverted from landfills, and I know some folks talk about, quality jobs created. But what are the kind of just a few examples of what we're actually measuring against?
So, David, there's 2 ways to do this. So one is a top-down measurement where you choose a couple of metrics. We kind of saw between 3 and 5 metrics for an entire portfolio. And in that case, you're looking at things like jobs, CO2 emissions, some of the larger, particularly the scientific-based metrics, or livelihoods improved, those types of things. But what we actually saw increasingly is that funds, and particularly funds that have done this a couple of times, are actually using bottom-up metrics. And so that means that they allow the actual loan managers or the investment managers in their due diligence often to set targets for these companies and then roll those up at the portfolio level. So instead of it being 3 metrics for a diverse set of enterprises, it's contextual metrics for each enterprise, and then the ability of the fund to hit those targets is rolled up to the portfolio level. And so, there might be if you hit 80% of the targets, you get this much. If you hit 85% of the target. And so when we look at some of those contextual metrics, many are from Iris Plus, so things, but they can be very specific to an organization. So, on the green side, things that are relatively, normal, so megawatts of solar energy, etc. And then you can get to, so for instance, on the mental health of the people that you're working with, you're looking at the level of empoweredness of women, of people within media. There's a lot of ways in which these contextual metrics can actually be very bespoke, or using, Iris, Gen, etc. And so we saw a range between some of these kind of very high level, portfolio level metrics and the contextual ones. And for me, I think that was one of the biggest learnings of this. And I think what it does, I hope, is really give all the fund managers on the call and out there this feeling of not having to get it right. Because I think what stopped a lot of people from using impact-linked compensation was having to sit back and pick 3 metrics that, for a diverse portfolio, that was able to capture all of the impact that was being done. And I think when we've talked about some of the pushback over the years, it's been, well, you're never going to get the right metrics. You're never going to get the right metrics. And so having contextualized metrics with flexibility and a learning mindset changes what this is. This is a formalization of an impact thesis into the incentives of individuals within a fund that does not require, a top-down approach that is, set out in year 1 and only really measured in year 12.
Great. Well, stick around, Aunnie, and you're going to be our kind of expert commentator, but let's bring in some of the managers and practitioners that are actually implementing some of these practices. And Uli, maybe just let us know sort of your journey to impact incentives, as it were, and maybe set the context. I know the European Investment Fund is part of the European Investment Bank, which is part of the European Union, but maybe just tell us who you are and how this works in your shop.
Yeah, hi everyone. I'm indeed at the European Investment Fund. I'm heading the equity operations in EIF. And part of that universe is also impact investing activities, which we started back in 2013, after I had come back from a 2-year research break doing research on impact investing with 75 of the largest single family offices worldwide, to see how they combine investment strategies that look at financial return and impact at the same time. And on that basis, we basically have been setting off at EIF to introduce the first fund of fund with a dedicated impact focus at the time on social impact themes. Meanwhile, we have actually extended that to the full spectrum of impact themes, including environmental impact and the like. And we see more and more venture capital firms and even private equity firms that are totally unrelated to specific impact themes to integrate a measurement of impact in their portfolios, and some of them have actually, on a voluntary basis, also integrated the linkage between carried interest and financial and the financial performance on one side with impact metrics on the other side. So it's something that is going, as we speak, far beyond the genuine original impact investment approach that we've seen 10 years ago.
So you've got in addition to specifically, you've got a fund of funds, and the managers that you select in that are required by you or selected by you on the basis that they implement some kind of impact incentives, or they're doing it on their own? And
no, it's a requirement on the impact investment.
Work?
Yeah, on the impact investment activities that we run dedicated to environmental impact or social impact, we do require our fund managers to have a linkage between impact performance and financial performance in the fund. Although I think there's one difference, and Aunnie has been referring to that as a flexibility that is built into the system. From our perspective, it is important to know that the impact linkage of the carried interest is not a remuneration for impact units being achieved. we introduced the impact link and to carried interest and the carried interest link to impact in order to substantiate that the investment strategies that we invested in that deliver financial return do deliver the financial return on the basis of an impact strategy, as opposed to impact being a collateral side effect in the investment process. And after 10 or 12 years, we look back and say, okay, in this and this investment, this and this impact has happened. And hence, this is something that we are going to use for marketing now. And the one thing that has enabled us to do that is that we have been clear in the first instance about the impact that we wanted to achieve ourselves. When we were selecting an investment strategy of a fund manager, we were deliberately selecting an investment strategy of a fund manager because they were going into a field that was of relevance for us. And hence the requirement on them to actually define for every investment that they're making with respect to the theory of change of the underlying portfolio company, and to measure their progress towards the achievement of this theory of change that was expressed in tangible KPIs, was giving us basically the safeguard that the financial performance that we were looking at eventually at the end of the investment period of our fund of fund in the investments in funds that we have been executing have been genuinely driven by an impact agenda that we had in the mind in the first place.
That's you make a point, which is that if the fund, I think it may be more appropriate at the enterprise level, but people talk about collinearity. If the enterprise is delivering impact as an essential and integral part of its business, then the financial results of that business should correlate well with the impact of that business, and therefore you could just look at the financial results. You wouldn't need to have a separate measurement. But obviously at the fund level, maybe that's not quite as, the collinearity is not quite as direct.
That's true. On the other side, I think it is also in a way necessary to make a call to reason in terms of what do we expect at what level of the food chain when it comes to impact investing, because very often we actually brag ourselves as an industry at fund of fund level or even at fund level that we are creating the impact. The reality is we don't. The impact is created at level of the portfolio companies. The only thing that we can claim at the level of a fund, or as a matter of fact, also at the level of a fund, is the ability to select enterprises or fund managers that are able to select or deliver at their level impact in a given domain. And this is basically the impact performance that we are remunerating through an impact-linked carried interest.
Uli, it's my understanding, I think that EIF has, you have a specific methodology that the fund managers you invest in must follow. Is that correct?
Yes, it's a methodology, but the methodology is actually merely a framework. As I said before, we are not giving in a prescriptive manner the kind of indicators that fund managers need to adopt. We don't tell them that they need to measure CO2 footprint or they need to measure people taken out of unemployment and reintegrated in the job market or things like that. We actually give, the only thing that we basically give them is that they have to define at the point in time where they make the investment, the theory of change of the portfolio company that is pursued, and to express that theory of change in KPIs and impact targets that they consider being relevant for proving that the theory of change that the company is going after has been materialized. And we give them the full flexibility in terms of indicators that they want to use for that. But the mere fact that they have to make this judgment call of what is an expression of a theory of change and share that with the investors and get it validated at that level, the mere effect of having to do this judgment call at the point in time where they make the investment, they actually need to commit themselves to a strategy that they need to pursue, and that they are actually, as a matter of fact, also measured against the achievement.
I wanted to ask, I mean, you've been doing this for a few years now. What have you observed from your portfolio since implementing this? I mean, just briefly, have you seen deeper, more ambitious impact targets? Have your fund managers that you've invested in, given you feedback on how onerous or burdensome this process is? And, what have you learned?
I think the first thing that we learned was at the very, very beginning, because having this requirement made it very easy for us to distinguish between ESG funds and impact funds. Because ESG funds at the time were very cautious and hesitant of committing to anything, because for them, very frequently, the type of impact that they're looking at is the result of a kind of negative screening approach, of a kind of eligibility type of approach to making investments, whilst impact funds typically go after very specific targets when they make an investment.
Nice.
And hence the liberty that we gave them in defining impact targets that express the theory of change of the portfolio companies. That actually made most of the fund managers very comfortable with the approach from the outset, because they could use virtually any indicator that they considered being representative for this theory of change in a portfolio company, whether they wanted to use iris indicators or whether they wanted to define their own, or even tailor-made things that are used at company level. That doesn't really matter to us in our approach. We want to have indicators that are as close as possible to indicators that a portfolio company uses itself to run its business. And the advantage that we draw from that was that even at the level of the portfolio company, the resistance to having this type of impact tracking was not perceived as being cumbersome, because they needed that information anyways to run their business. And for us, the advantage was that given the fact that the company used the same indicators to run their business, we could rely to a high degree on the reliability of the information that we got, because we didn't have to second guess whether those impact indicators have been made up or whatever, because we could read them basically from the impact planning in the business plans of the portfolio companies themselves.
Uli, the obvious question to be asked at the end here is your compensation or your team's compensation linked to impact, and how?
The answer is 3 letters, yes, and it's actually EIF's remuneration of as a fund manager is tied exactly in the same way to the performance of our underlying products as we required from the fund managers.
Great, thank you. Again, stick around and chime in, but let's move to Santiago Alvarez from Alive Ventures. Santiago, I think that Alive, and maybe you can also explain Alive. I know the A stands for acumen, which people know, but adopted impact-linked carry way back in 2018. I think you had to kind of do it yourself in terms of developing the framework. So maybe just tell us Alive's story.
Yes, David. So, I mean, just the origin. Alive was sponsored by Acumen. So back in 2016, sort of we set out to create a Latin America dedicated fund manager to do sort of impact investments, initially mostly in the Andean region. And then Acumen plays sort of a very important role, sort of setting the fund and providing sort of a strategic partnership to Alive, sort of to get off the ground. We operate as a completely independent entity, but we do share, I think the spirits and alignments in terms of impact, and also, it's kind of the community. And yes, sort of, we started, as I mentioned, in 2016, sort of structuring our first fund. It took us 2 years sort of to get to a first close, so a very challenging task back then. But from the beginning, sort of, I think we at Alive sort of identified that we wanted sort of to be really accountable sort of for the strategy that we were sort of trying to achieve. And that's when sort of we started with the discussion about sort of impact-linked compensations. At that point in time, we did significant research sort of to try to understand what was the market doing. And it was really challenging sort of to really sort of get any evidence of others sort of trying to do something even similar. So ultimately, we ended up sort of creating our own impact linked structure, which is based actually on the numbers of lives impacted, so that people know a lives strategy is in terms of impact, is mostly about sort of reducing the inequality gap in the region and lifting people out of poverty, sort of investing in businesses that a significant part of their customers are people living in underserved conditions, and therefore that the product and the service they access sort of improve the quality of life of people. And so initially we created sort of this structure based on the numbers of lives impacted. So it was just one dimension of impact, and our first fund has been already going through several iterations of adjusting sort of the impact structure, because as I think Annie pointed out, I mean, we tried sort of to create something very robust from the beginning, but we didn't anticipate it, sort of how many challenges and unknowns we would face sort of along the way.
Santiago, you and I spoke a little bit about this yesterday, and you talked about how you went you made it almost too complicated when you started, right? Like trying to think through everything possibly, because there wasn't necessarily a methodology for you to follow at the time. Can you share an example of just what didn't work, what you learned, and how you have since evolved the model for your second fund?
Absolutely, Jessica. So our fund, sort of our first fund, was a sectorial fund. So we would invest in education companies, in agribusiness, and in access to energy. Those were sort of our three pillars. And we created from the onset a methodology in which each of our portfolio companies were to be ranked in terms of impact, and whether there would be high, medium, or low impact companies based on the numbers of lives impacted by each portfolio company. And so, first challenge, it was very difficult sort of to compare sort of the impact of an agribusiness than an education technology company, right? And so we, at the beginning, we created different thresholds for each sector, because, if you're talking about agribusinesses, it's just a limited number of lives impacted by a single company. If you're talking about education technology, it could be in the hundreds of thousands, right? And so initially, sort of we created different bands or thresholds for it to be the high, the medium, and the low. And to your specific question, in the agribusiness, the thresholds we created were misaligned. Our expectations is that a high impact company in the agribusiness sector would be a company impacting over 5,000 lives. And ultimately, when we were trying to deploy capital, we couldn't find any company sort of reaching that level of impact, right? And so 2 years down the road, we actually went back sort of to our LPAC and shared that we felt this structure was creating a perverse incentive of not investing in agribusinesses, because based on the methodology we had created, we were not achieving sort of a high impact score, which was eventually a miss for us. Locally, I think also our pool of investors and the LPAC we had built sort of the capacity sort of to adjust the mechanism, and we've had a pool of investors sort of that they have been very flexible in understanding sort of that there's been a learning process, and we've been able sort of to adjust the process along the way, but again, sort of with challenges, not only for just share one example, but there's been many. And so to your second question, Jessica, for our second fund, which is a fund that we just closed, had a first close back in 2023, last year. It's a fund that we decided not to replicate sort of that impact structure, because it had been very challenging, very complex from the onset. And so again, we did a research process sort of to understand what was available in the market, and we end up sort of concluding that we wanted to use kind of a more kind of a widely adopted framework to be able to also create some comparability in terms of impact. And that's when ultimately we ended up using the impact management project as the framework sort of to our new methodology. And also because sort of, as I mentioned in our first fund, the impact methodology was only one dimension, which was breadth of impact, which ultimately has also, very important challenges in terms of accountability. And now with the impact management project framework, we are incorporating also sort of depth of impact and other variables sort of that we think are important sort of for our strategy. So that's been sort of kind of our journey and some of the iterations we've taken.
Awesome. I want to ask just one follow-up question, and just to remind folks that if you have questions, please drop them in the chat, and we're looking at them as we go. And there's one question that came in from Dan Block of Mercy Corps Ventures, and Santiago, I'll put this to you. You mentioned how you've adjusted your incentives methodology and process, but being, having this impact linked carry embedded in your fund, has that influenced your investment strategy at all, and or sort of the post-investment guidance that you're offering to your portfolio companies? And if it has, how has that transpired?
It has indeed, no question. Because I mean, really, sort of it's our incentives are contingent sort of to achieving sort of that impact hurdle. In our case, it also works sort of as an impact hurdle in terms that either whether we achieve sort of the expected impact, it unlocks sort of our possibility sort of to access 100% of our impact. If we don't, then we would only access sort of 50% of the impact. That's kind of the incentive created there. And so just to give you sort of a concrete example, Jessica, and to Dan, is what I just shared with the agribusiness strategy. We, like, for every pipeline opportunity that we assess, we run that opportunity also through our impact scoring, which is also tied sort of to our impact link to our carry, and we assess sort of what's sort of the expected impact of the company along the way, sort of when we sort of look at sort of our forecast of the company. And for example, in the agribusiness space, sort of there were businesses in which we just, we passed on the opportunity because we felt sort of the impact the company was achieving in terms of numbers of lives impacted was very low. And it would not met sort of our high impact threshold initially. So I think for us, in which impact, as sort of Uli shared as well, sort of impact is front and center from our strategy. Impact is in terms that the companies, it has to be in the DNA of the business model, and it's something that is baked into our due diligence process and is one of sort of our criteria for investment. Considering that the impact carry sort of was built based on our sort of impact thesis, it has definitely played a role in terms of influencing whether we move forward or not with the strategy, with that particular investment, sorry. And as well, sort of to the point in terms of portfolio management, on an annual basis, sort of we review sort of how the fund is performing as well against sort of this impact score. And we've had a sort of instances in which companies sort of that we had the expectation they could be farther down the road in terms of achieving greater impact, and they have not. It has led us sort of to try to look for projects, consultants, even in some instances, sort of to try to support the companies, understand better sort of what's happening in terms of impact, what they could do better. So try to also move towards the direction in which we want the company to be focusing on.
Terrific, Santiago. I think we're pointing out the importance, as Aunnie said at the top, about flexibility. Let's move on to Gilberto and Vox. And Gilberto, some of the same questions, but let me just put it to you. The first at the top, was this something that Vox adopted because of pressure from your investors, from your limited partners, or is this something that Vox itself pioneered when you started the incentive structure?
Thank you, David. No, actually, it was us. It was a matter of walking the talk, because we were the first ones here in Brazil to start talking about the concept of having both financial and impact returns. And at that point, we thought that the whole structure of the industry is based on an incentive that only sees one bottom line. And we thought that if we were to kind of reframe the system, we needed to fix that as well, not only through our investments, but also on how we compensate ourselves. Needless to say that there wasn't any sort of metric or benchmark to go after. So what we did is we designed in the fund bylaws in the LPA and all the documentation, saying that we were going to forfeit up to 50% of our compensation if we didn't find how to do that. But in the upcoming years, we would have an AGM deciding on how to do so, when to do so. And right after the start of the structuring of our first fund, we joined the Gears Pioneers program. I don't know if some of us here are old enough to remember Gears. Gears is it's an acronym that stands for Global Impact Investing Rating System. It was used to be run by B Lab, and they were trying to design a system where they could compare different impact funds and have a score, and said, well, this can be something. And we started with Gears. We were one of the Gears pioneers, and I believe Gears was terminated in 2014 or 15. Then we iterated from there.
Are there, what would you say the takeaways or the learnings or the best practices that you would pass along to folks coming in now?
Well, it's much easier said than done. It's like, okay, let's tie compensation to impacts, but you end up in a place similar to what Aunnie did when she made the provocation. How do I do so? And what we learn is that since this is a kind of a mindset change, we try to do things as similar as they were done in the financial side of the brain of the person. So first thing is that we got a lot of critics saying, oh, B impact assessment score is not a proper impact evaluation, or Gears is not a proper, like Gears score is not a proper impact metric, so on and so forth. What we started showing people is that your metric for carry is one portion of a complete system of accounting. So you have your impact management framework, and you have your theory of change, you monitor your business, and you draw one of the metrics and say, look, this is a proxy of all the system going well. And if this proxy shows that we are performing, this is how I tie my compensation. And if you establish a parallel with the financial side, most of the funds, they track IRR and said, okay, if I have a surplus of, let's say, everything after 6% in dollars, 20% is mine. I said, oh, IRR is not a complete financial metric to the healthy of a portfolio. Exactly. You have like accountants and auditors and P&Ls and things like that. And so we said, what we were trying to say there is like, this is the tip of the iceberg. This is how you start. Second learning is that it's burdensome. It's burdensome. You have to engage your investees on tracking things that they are not used to. If metrics are related to their core businesses, it helps. But even in this situation, since we were a seed and early stage fund, most of the companies, they do not have enough professionals to do like accounting and things like this. So you need to be gentle and help your stakeholders to embark in this new journey. And the way to do so, the way to engage them is to make your burden, your need as valuable as possible to your investee. And how did we do that? So right now, the metrics on our funds 1 to 3 are basically the impact assessment scores aggregated at the portfolio level. And my performance, like my impact hurdle, it's 80 points at this score. And why 80 points? This is what you need to qualify as a B corporation. So we didn't invented the hurdle. We said, okay, if maybe there is some science behind on how B corporation did that, and we will follow. So if my fund has a lower bar than 80 points on aggregate, I lose my impact compensation. So we started running the impact assessments and auditing them on the portfolio companies. And afterwards, we were showing them like, look, this is something that you're lacking. This can make your business better. This can help you position yourself better for attracting new employees. And we designed this community around impact management. And companies, at some point of the journey, companies started competing against themselves and said, oh, next year I will be the better performer of the portfolio and things like that. So you need to make this useful. And actually this is costful as well. So the same way you need to pay auditors to track your financials, if you want to have like a decent level of governance on your metrics, that you would like to invite third party reviewers on what you're tracking. So there are costs associated. You need to negotiate with LPs. We had the luck to have IDB funding on our Fund 1. They had like a TA, a technical assistance vehicle set aside that help us pay for the system in the beginning. So you need to put this on your budget as well, not only on your intentions. And you need to be prepared to need to redo everything from scratch. So it happened with us in 2014 when Gears was terminated. So we had to call an AGM, talk to all of our LPs and say, look, do you remember that new thing we were trying? Yeah, it doesn't exist anymore. We came up with a different design. Let's agree on this design. And so things probably will change because we're on a novel industry. So building this flexibility is super important for you not to put yourself at risk, like fiduciary risk or even compensation risk. We were highly advised against doing so by our lawyers and said, no, there's no regulation on it. You shouldn't put this on an LPA. But what we did is we put it on and we put safeguards on governance every time we need to adapt and iterate.
Quick question, Gilberto. Have you ever not gotten your compensation because of shortfalls and impact in your own portfolio?
Not yet. So Fund 1, it has a good impact performance, but it doesn't have a good financial one. So this is something interesting on the design. If I do not have carried interest, it doesn't. I can pay my carried compensation despite having an impact. And I saw a question on the chat, and this is a massive challenge for blended finance and things like that. If you tie everything to profits, if you do not have profit, despite having impacts or having some sort of metric that points towards the impact, you cannot be compensated. For Fund 2, which is 2016 vintage, this fund, it's a very good performer on, like, we already gave back big chunk of the capital back to the LPs. We are reaching a hurdle, and it's also performing well on impact. And the good thing is that there is a correlation between the best investments and the best impact performances as well.
Nice, nice. All right, thank you very much. And just so everybody knows, we always keep the room open a little bit past the hour, and we're obviously running a little bit behind, but we will keep it open. So stick around if you can, and we'll keep the conversation. We want to get Bjoern Struewer. So I know again, you cautioned me that I wasn't going to get that right, but just give us the sequence of Roots of Impact's work. I know you started really at the enterprise level, as Uli and others said. That's where the impact is, and now you're kind of moving up the food chain.
Yeah, let's say we came actually in this in 2016 with the first social impact incentives, and the whole idea was very different. Like, we have a very different focus, as you said. And we also had different ambitions in terms of creating additionality in these transactions. And it was a bit like, hey, if you want to encourage and enable a company or even a portfolio of companies to create greater and better impact, you're not necessarily talking to their investors, right? So you are talking to the companies and their management teams and the founders, etc. And also learning from the carbon market with incentives, you can really do a lot. And so we started actually to provide rewards directly to the companies, impact incentives. And we structured as blended finance deals. Nowadays, we are also doing different things. The idea is always the same. The better your impact, the lower your capital cost. And this really creates strong incentives on company level. And then you can really unlock the potential that is still there, because there's always, even the best companies, there's always something to improve in terms of very specific impact objectives. Think of gender, for example. You can, with incentives, can really unlock also very specific types of impact. And of course, this has to be always fully aligned with the company. And co-created, actually bottom up, purely bottom up. And however, I also learned from Aunnie's research that, because I was quite skeptical, to be honest, at the beginning, like, hey, what kind of effect do investors have on the company impact? But as Uli said, and also Aunnie, well, they have to select the impact top performers, right? That's the role of an investor, but not necessarily managing the company in a way that they create more impact. And we are creating the incentives, actually, that the companies by themselves have a strong interest in outperforming on impact.
Bjoern, I know you've been doing this work in structuring incentive structures for 8 years or so. I remember the first couple of deals that you all helped put together at Roots of Impact, but it's my understanding now that you all are looking at how to move up the impact food chain, so to speak, right? And look at these other pressure points where incentives can be compounded.
Well, it's rather that we now that actually, as you all have also reported on, we see the traction in the market. Like, we are all talking about incentives these days, right? And this took a while. And now we think we are ready. Also, our market of impact-linked finance directly concerning companies is taking up massively, taking off. And we are now actually changing our focus towards, now at the moment, we are kind of a fund manager or an incentive manager. And we are now changing our focus, helping fund managers, helping others to actually apply impact-linked finance. Not necessarily impact-linked compensation, but impact-linked finance as we did it in the past, because we had a lot of requests actually already from fund managers who have pressures from their LP. And they told us, look, we have some TA money, but we don't think with this TA, this is effective enough to achieve this very ambitious targets we now have from our LPs. We want to use incentives now. And can you help us? And this is the next wave I would expect.
Great.
We've got a bunch of questions coming in, and Aunnie, you're a sort of human chat GPT on impact incentives here, responding to all these questions in the chat. So some of them have been answered, but this I think goes to your TA question, Bjoern, from Julie Abrams. What about portfolios that incur impact expenses that do not generate financial returns, but are purely an expense? This is the case for some nature conservation expenses, excluding carbon credits and other forms of impact. So where does I guess maybe that's the question, where does the impetus, and several of the managers have raised this, how do you cover just actually setting up the system?
We are now experts in raising funding from donors and in particular public funders. So what we are mostly doing is blended finance, because to have enough gunpowder also to work with incentives, somebody needs to pay for it, right? And this, by the way, also pays then the measurement. So we don't expect fund managers to pay for this, etc. And then there's a whole spectrum. And then, of course, there's the question, is it still efficient enough? We have a focus on market-based solutions. And we strongly believe that market-based solutions businesses all have the potential to do better with the right incentives in place.
Great. It is now at the top of the hour. Obviously, if you have other appointments, that's on you. But we're going to stick here for a few minutes if the speakers can stick around and keep the conversation going. And Aunnie, maybe just circle back around and comment on what you've heard and what folks should be taking away from what we've heard so far.
Yeah, I think it's nice when all the speakers don't contradict anything that you spent a year putting together the research of. So I think the things that I heard that were very much reflected in our report were things around flexibility. This not being a punitive measure that LPs are trying to in many cases, what we saw, as what's in the chat, is that LPs would still pay the carry, actually, that it would be donated. So there's no one wins if the impact's not achieved. And so figuring out how to align that. So that's really important. I think another thing that, we heard from Uli, and this was, clear from very early conversations that I had with Uli years ago, was, this, like, what is the difference between an ESG and an impact fund? And an impact fund should be held accountable. And I very clearly believe, and you said at the top of the call, David, that like we're on how now. This is no longer, we're not sitting around debating like, should we incentivize based off of impact? Like now we're on like, how do you do it well? Like, let's do it well, because we're not going to draw the line between impact funds and ESG funds if our impact funds actually have fewer incentives around what we're trying to create than the ESG funds. So I think that, there's just the excuses around it are really running out. And so I think that, being able to see that, the funds that are doing this are doing an excellent job, but it doesn't have to be perfect. Again, going back to the flexibility. And then also, the thing that I heard, and, this is from Santiago, and, some of what I'm saying was from Santiago originally feeding back into me. But looking at, how do we think about whether it's top down or bottom up, using whether it's very contextual metrics or very standardized metrics, but like how do we move towards something that really allows, that is actually appropriate for our portfolios? And that's what's starting to happen as funds are in their second, third fund, that they're applying these incentives. And for me, that underscores what I said at the beginning as well, which is this is a learning mindset. Going into this and trying to get this perfect is why people stop and they don't actually implement it. Going in with a learning mindset, creating strong governance so that, you can't just change the metric from 1 to, 0.2 because you want to, but you go back to an LPAC or to an external committee. One of the things I saw in the chat, people were asking, well, how do you do external verification? we saw external verification at the hurdle level, at the target level, at the individual, at the process level, at the actual data collection level. And this can be hiring a firm like a 60 decibels or a Blue Mark. It can be having a person that you go to and you say, like, does this target make sense? You are an expert at X. And so there are so many different ways to do this. And what I would really encourage people to do, I threw a link up, I'll put another one in, is, we spent a year basically putting all of this wisdom together from other people, not from us. And the report is too long, but it's a lot of pages and a ton of case studies on this. And we've gone into pretty much every question that's been asked on the chat. Like, there's a section in the report on. I actually kind of stopped typing that because I felt like I was just kind of saying it over and over again.
The question I asked earlier, but Uli, maybe you have some view on this, is where is the impulse coming for this? Is it coming from LPs and allocators who want to, make sure that they're going to have impact in the funds they invest in? Is it coming from GPs who are trying to differentiate themselves perhaps and attract LPs? Where's the motivation?
I think throughout the journey that we've done with impact-linked carried interest, it's noticeable that the interest and the commitment from the GP community was much, much bigger than from the LP community. I think on the LP community, we have observed right from the beginning a certain number of constituencies that naturally look at beyond financial return type of investment, purpose-driven investment, mission-driven investment, very frequently driven by family offices or by also institutions that have themselves an accountability to their stakeholder community for what they achieve in terms of investment results and beyond financial return results. But the biggest uptake of the idea of linking carried interest to impact performance came from the GP community, as you said, for reasons of creating authenticity around the investment strategy. And for us, this was the main purpose in the beginning, that we basically get from our fund managers the performance related to the strategy that they basically sold us in the first place, so that we got what's written on the tin. And for the impact investors that generally really went after impact, it was the only way for them to differentiate themselves from all the fund managers that have picked up the train of the kind of sexiness of impact as a marketing instrument. And nowadays, actually, if you don't have anything linked to some kind of impact or sustainability consciousness, it's very difficult to go to the market. So everybody tries to connect to that. But those that actually tie their own skin to the performance and to the strategy that is looking for impact have a different stance in the market.
I'm gonna put a question in. We had one about just how impact formula deal with the issue of the investment sort of timeline, like the long tail, contribution to the economy, overall contribution to the community health. So how would various impact incentive mechanisms account for that, particularly like an annual bonus? I'll leave that to, Aunnie, maybe you're the best position to
This was John
respond to that.
Laray's question, that finance might get measured on an annual basis, but impact might take longer.
Yeah, so what we've said in our in the report is that one of the things you have to look at is what is the time frame. So this is also not a one size fits all. So there are ways in which, so every portfolio has different levels of impact, and so there might be things that, for instance, funds that are just doing carry, often that's at a senior level and for more senior staff, and so you might have a fund that wants to do kind of more short-term bonuses for more junior staff that might look at and find ways to do that from an incentive perspective, but it has to match. And I think that's where it's when we think about accounting, there's a matching principle as well. And so thinking through what proxies potentially would make sense for a shorter term bonus that then leads to a longer term bonus. And, I think I've been a little bit kind of tongue in cheek in the chat, like just about why are we even still using carry? Like, what makes 20%? Like, why is 20% the magic number? And, I think the thing that we've heard a lot is, well, it should be more than what? Like someone just made up, actually 20% comes from a legal quirk in the tax code of the US government, or like it's a weird, it's a weird number from a weird place that has no scientific background. So I think that, when we're starting to look at how do we design incentive structures, the ideal is actually, I would say, to start from scratch. So what are you trying to incentivize? What is the time frame? And how do you want that to play out for your employees? And how is that affected by the profits and the cash flow, et cetera? And I think that's where, we don't have to, I know it makes it much easier to just kind of copy paste what the traditional financial market does. But I do think we're starting to get to the place in the impact investing space where we can start to throw out some of the kind of traditional financial structures. And that's my own, many of you that call know, that's my own kind of view, is that I think we should be starting from scratch. So I really get a little oh, it should be more than 20%. Again, there's no basis there. How do we build incentive structures that actually get us to where we want to go? And it might be a combination of performance evaluation, bonuses, short-term, long-term bonuses, some sort of long-term carry profit incentive, and figuring that out based off of what you're trying to incentivize, how that data is collected and how that data is verified is part of that bottom-up approach to designing that, I think.
This might have some relationship to that question from Lori Michelson. Has adopting impact-linked compensation affected recruitment and retention at your firm? Like, does this make managers want to come in and run portfolios, or does it make them run for the hills? Santiago or Gilberto, maybe most, or Uli, I suppose, or Bjoern.
I think in our case, David, impact is so front and center from our strategy that the people that are attracted sort of to Alive on the first instance, for them it actually feels as a way of accountability of this is actually sort of a place where as also we're discussed just a minute ago where impact is not a future, or it's actually it is a core, and so we haven't seen any challenge whatsoever in terms of recruiting.
Great.
I wouldn't say that there is challenge in recruiting, but what I see in terms of people management is that actually the incentives work. So once an analyst or a fund manager starts seeing a poor performer in his books and starts thinking about, oh, how can I improve his score? How can we help this entrepreneur to enhance the impact? Because they know that their compensation is ultimately tied to that. So you see changing the behavior, but in a good way, not in a bad way.
Great. One more question, and this may be the final official question, and it's probably a good one, is from Diederik Volke. How do you look at potential conflicts between fiduciary duties, for example, of pension funds, to make the most return and impact-linked carry?
Well, this one is a tough one. Diederik also should be in the panel. He's one of the pioneers of tying Wires Group returns to impact as well. In Brazil, fiduciary,
and Jessica had Wire Group in some of the write-ups, so we can reference that.
Well, in Brazil, fiduciary duty is still defined as Milton Friedman would love to, and right now we're taking a legal risk ourselves. We do not have pension funds as LPs. Last year, Brazil it was last year Brazil passed on a new directive for pension funds saying that they are allowed to consider ESG implications. They are not required to So we're starting to change the lexicon around fiduciary duty, but we're still like far from being safe.
Other
I
thoughts
would
on that? I know you answered a little bit of it in the chat, Aunnie.
I would just add very briefly, David, add that I think we need to recognize that in the impact investing space, there is a spectrum and of strategies. And really, I think sort of it might, I mean, that question also depends on sort of where you land in terms of that spectrum and whether sort of your strategy, you know, considers sort of concessionary potential returns because of the impact. And so at that point, then you could get some challenges, but so like, for example, sort of in our strategy, we actually think that impact goes hand in hand with the value proposition of the business, and therefore actually sort of enhancing the impact has a direct correlation of better achievement, better performance of the portfolio company, which eliminates that discussion.
Great, great. I do want to provide an opportunity. Chintan, your screen name is Aaron Bork, who I think is your colleague there.
I'm in disguise.
Oh, that makes so much more sense to me now. Okay, I'm like, oh, that makes so much more sense to me now.
But you and Aaron actually had a good post in Impact Alpha responding to Aunnie a couple years ago, and it was in the spirit, I know, of constructive criticism and sort of elucidating some of the challenges. What have you heard today that either moves the ball forward or raises more questions?
Yeah, it's a great question. Thank you. So first of all, I'll just kind of start out by saying I think the ball has been moving forward kind of decisively, you know, ever since, you know, folks like Aunnie started talking about this. You know, in our article, we tried to kind of point out some of the challenges that need to be addressed and thought about when building this. And I think it's really like well summed up in kind of the way that Aunnie describes, you know, kind of a learning and building mindset. And it really needs, this is really not a one size fits all, kind of pull it off the shelf and just apply it type of a, you know, type of a kind of a structure. It really does need to be kind of custom tailored to the situation, to the manager. And I think Bjoern makes a really good point about the underlying companies that are generating the impact, right? I think that's really where it starts. That's actually a point that we didn't even think about in our article. So, you know, kind of kudos to Bjoern. But I think that, you know, the report, I think does a great job of addressing the various different kind of points that we raised. And we raised those just from a practical perspective, you know, from having built this, you know, into a number of different, you know, kind of investment vehicles. So it's, I think it's a meaningful progression of the ball, so to speak.
And imagine a good line of business for lawyers to be able to work out all the particulars. So the more complicated, the better, right?
For sure. Yes.
I know Jessica Pothering has got to run off to catch a flight, so I want to send her off and thank you, Jessica, for all your work in pulling the call together and your coverage. But we'll keep the call open for just a couple more minutes. But thanks, Jessica.
Thank you, everyone. More to follow up on this for sure.
I just want to give everybody the other speakers, you know, one last round of final thoughts and perhaps you know, it could even be in the form of questions that are left unanswered. And then Aunnie, I was going to give you the final word to talk about where the research goes from here. So maybe you follow up. Yeah, yeah.
Maybe let me start because I really have one bit provocative thought. Because when I entered the impact investing industry 2012, I came from banking, from mainstream finance. Was what I found, and this is very much what also Aunnie shared, is that the whole impact investing industry was working with exactly the same tools that I knew from banking, 100% the same, and no incentives at all, no accountability, no means actually, no tools in place actually to be really different and to do something different and to encourage or enable companies to deliver impact. And I think it's fantastic that we are now at this stage talking about this, but still, I think this would have been due since 10 years, right? So we should speed up a bit with these discussions, and also, for example, pension funds and fiduciary duties, etc. I think we really need to change the conversation towards better tools, and not why and why not, like how and how to make it happen, because at the end of the day, it is possible. I just leave it there, because I just was reminded when this pension fund topic came up, how it was actually when I came, and this was very much the big question, like what is going on here? What is so different? It's not different at all.
Great. Santiago?
Sure. So I would actually also share a thought in terms that I really think sort of we need to move towards the how. I agree, but also in terms of comparability. As I mentioned, sort of we created sort of our first sort of methodology, our first fund. It didn't work out well. We have improved it, but it was, it was kind of a test. And if that's not shared broadly, if we don't adopt something that has comparability, we're, I think, losing the risk of not creating sort of an ecosystem. And if the impact investing community is not accountable sort of to what we're trying to achieve, I think we're also risking that, the impact is just a buzzword, but ultimately things don't change. So I highly encourage everyone sort of that we share more. I think that the study that Aunnie was leading is a fantastic tool, but we need sort of to continue on that path of sharing more and creating tools that create comparability, so that anyone sort of can look at and take make informed sort of judgments of around impact.
Great. Gilberto?
Wow, I love the provocation that Bjoern did, and I would go further on it. Being at this industry for a dozen years now, I keep seeing my peers and my colleagues being pressured, and this is not serious enough, this is not regulated enough, this is not good enough. And the only thing I see is that we're improving. We as practitioners, we're improving a failed system. And I think what pension funds should start asking themselves, like, would they be paying performance for funds related to the subprime crisis in the US if they had some sort of system like that? Would they be compensating managers that were responsible for all the major crises that we had in the past? So why does the traditional finance gets us lack and keeps living on without acknowledging that there is no money allocation without responsibility, without some sort of consequence? And this is my message for everyone.
Beautiful. Uli?
Well, at the risk of spoiling the party, I think I would advocate for going back from the question of the how to go back to the question of what. And not necessarily what in terms of carry link and remuneration or things like that, but to ask ourselves as an impact investment community, what type of impact we are investing in, and whether this is the right impact that we're investing in. Because ultimately, if we look at our industry, as much as we believe that we are ahead of the curve and possibly more ethical than the rest of the financial markets, we need to admit that in our investment approach, even in the impact investment space, we are still very much addicted to opportunistic impact investing. And we go for the impact that is easy to achieve or convenient to achieve or convenient to invest in, and that complies with risk return considerations that fit with our investor profiles and alike. But we don't ask ourselves very much the question of how we can actually get funding to the impact that is not convenient, but very much necessary to secure our sustainability. And I think that is a very, very big gap that we have in the impact investment industry to solve.
Well, good. And Aunnie, wrap it up.
Sure. After
Where to from here?
Beautiful. So yeah, some beautiful responses. I do agree. I think the one thing, Santiago, that I would just say on the comparability, I totally agree with you being able to do that. But I think what's quite interesting is I see the way that impact measurement and management is moving is certainly towards benchmarks and being able to look across different kind of types of sectors, et cetera. But I do think this contextualization and target setting, so it's not necessarily moving to a few metrics, but as you are doing with the IMP, it's these contextual ways of measuring, and I think that is that's incredibly important. So I'm very heartened by what we saw in the last year of research, which is that there are in our space very courageous fund managers that some were being pressured by Uli, a few of them. The rest were just decided to do this because it was the right thing to do, and they may not have known how to do it perfectly, but they decided to try. And that's what Santiago said, that's what Gilberto said as well, and I think that's the important lesson here, is that we as an industry are doing hard things. And I think it's important, to Uli's point, that we keep pushing ourselves to make sure we're doing, systematically hard things, not opportunistically hard things. And I think that more data and having more incentives are the right way to do that. I also really welcome this conversation that we're starting to have around, are these incentives, if we start to link them to impact, do they even make sense? And I think that's the right conversation for the industry, in that we have wholesale adopted a lot of things from the traditional financial industry. And now as we try and adapt them, there is some tension. And so instead of saying, because there's this tension, we shouldn't do it, recognizing that tension and actually saying, well, where should the system be changed, as opposed to just tweaking metrics? And I think that's the right conversation for the industry to be having when we're thinking about, what does systemic change look like? What does a market that actually works for individuals look like, as opposed to just, should someone pay 25% versus 20% because they're having a little bit more impact? That's not the conversation. So I think I'm very heartened by that. What I would encourage everyone to do, check out the report. We are planning to work with a couple of funders that are going to keep the conversations ongoing, the community of practice that we've put together, because we see this as being very much a learning opportunity. There are others that are doing some research at the LP level, and I certainly think that in a few years there will be a follow-up on some of this. For now, I'm taking a break from impact-linked compensation and going back to writing my book on why we should just blow up the whole system. So, but the report's there for everyone in the meantime.
Well, I'm very heartened by the response to this call. We consistently find that these kind of how calls are very popular, and the impact management questions engage folks much more than maybe other people outside of our field would realize or appreciate. So all of you practitioners who have been educating us and educating each other, we really thank you. We, as Aunnie said and Uli said, and the rest of you, there's a whole beat to be mined in the future, and we'll stay on it if you will with us. So thanks to everybody who's joined the call. Thanks to our speakers. Thanks to the team at Impact Alpha, and we'll see you next time.
Bye.
Bye all.
Thank you all.
Bye-bye.